A private hedge fund called Archegos collapsed last month after borrowing billions from banks to make risky bets on stocks. Now the banks are out billions of dollars. How concerned are you that the financial system is blundering into the same kind of opaque, risky bets that led to the Great Recession in 2008?
This is an event that we're monitoring very carefully and working with regulators here and around the world.
Andrew, Credit Suisse is facing a crisis of confidence over the weekend, at least on certain social media platforms, with hordes of gadflies abuzz with proclamations of its, quote, Lehman moment. Now, the stock price slumping today as the firm's C-suite seeks to reassure investors that the bank is not on the brink of collapse.
Please disperse! Nothing to see here, please!
All right. Today is Wednesday, October 5th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and unfortunately, while the program is a good one, the topic we're about to talk about, it's not a good one. It's a 2008 deja vu kind of thing. A lot of folks are talking about 2008 and the similarities between then and now, and what's gonna break. What is the spark that will start the fire? Back then, it was Lehman. Today, could it be something that is already known to us, but we didn't know how bad it actually is? What are we talking about here? We're talking about Credit Suisse. We'll talk about that in a minute, but before we start, few notes. Note number one, apologies to our viewers in Australia and New Zealand. You couldn't access yesterday's video, and look, we got hit hard by YouTube yesterday for the silliest reasons. Remember when I talked yesterday about the analogy of the market being an addict to the Fed's generosity? Well, YouTube took that as something else. I'm not going to talk about it right now because I don't want this video to get hit too. But you can look at the screen, pause, and read for yourself what YouTube said and how they interpreted all of what I said. The dumb robots, of course. And even the human review got it wrong because they were too lazy to listen a little more and put it into context. On top of that, the video also got blocked in certain regions because I used a clip from the movie Margin Call right at the end of the video, 15 seconds out of a 45 plus minutes video, and we got a copyright hit, and it blocked folks from Australia and New Zealand from accessing the video. So to our friends from Dan Under, my apologies. This is YouTube. This is what we're dealing with here. I'll be more careful next time. But just a little note to YouTube in case they're listening. I've been loyal to you. You know this membership program that has so far been so successful in a short amount of time. I could have taken this to Patreon or any other platform, and they would be happy to have us over there. I chose to stick with YouTube. And all I'm saying is be careful because I have my limits too. There are things that are reasonable, there are things that are not reasonable. And last night's hit job against my video was not reasonable at all. We'll leave it at that. Now let's talk markets before we move on to the In Focus segment, because the market was down big today in the morning. We got a gap down. A lot of those dip buyers in the last 2 days, well, they got served a massive, nice, warm pie in the face right off the gate. And the thinking was, this is yet another bear market rally. It lasted for 2 days and now it's gone. But something happened midday. A rescue operation took place, and believe it or not, the market closed pretty much at the highs of the day. The Dow Jones, the S&P, the Nasdaq almost closed in the green, reversing massive losses from earlier in the day. And this rescue operation came from a mechanical reason, a gamma squeeze. There was a massive, big options trade that took place midday. Apparently, a large whale type of trader bought massive amount of call options for the S&P 500, betting that the S&P will be higher by January 2023. And immediately we saw a gamma squeeze. The market maker, the dealer, had to hedge by buying the S&P 500, and they bought a lot of it. And this was the reason behind the reversal today. We'll cover this specific trade in details in the options market segment, but before we do that, we have to talk about market movers once again. You see, the theory behind this rebound in the stock market right now is supported by technicals. Why? Because the June lows were recaptured. That's number one. Number two, the 200 weeks moving average in the S&P 500 remains fundamentals intact for now. But most importantly, we have severe oversold conditions across the market, and this is a recipe for a rebound rally, a relief rally, whatever we're going to call it, doesn't matter to me. But for the technicals to play out, you need a spark. And this spark usually comes from the fundamentals. You need supportive evidence from the fundamentals to spark the relief rally and allowing the ingredients in the technicals to play out and produce this relief rally. And then the mechanics come at play in sustaining the relief rally. So the question we have to ask right now is, we got a technical setup supporting a relief rally, and now we got a mechanical reason with this large options trade. But what was the fundamental reason that allowed this relief rally to start and continues to support it? Because if this fundamental reason goes away, the entire thesis behind this relief rally also falls apart. Now, according to the dip buyers and the market bulls who are supporting this relief rally and buying into this relief rally, bounce, whatever you want to call it, doesn't matter to me, their fundamental reasoning is a Fed pivot. And they floated many reasons why the Fed will pivot. All of these reasons turned out to be a bust. We're going to cover all of them in details in a minute, but the latest reason that is sticking right now to support a Fed pivot, an upcoming Fed pivot, is systemic financial risk. The bulls, the dip buyers, the whoever who are saying that the Fed is going to pivot are now saying, well, the Fed has no other choice but to pivot, because if they don't, we're going to see the systemic financial risk playing out and something is going to blow up. And the Fed, the last thing they want to do is blowing something up.
Some men just want to watch the world burn.
And perhaps the best evidence they're using to support this theory is what took place on Monday regarding Credit Suisse. Let's talk about it. But just an FYI before we start, parts of this segment were recorded on Monday. So if you hear me say today this and that happened, I mean Monday. So keep that in mind. And without further ado, here it is, in focus tonight. The ghosts of Lehman are starting to appear, and today we got one of them in Credit Suisse. But here's the background for you. You see, there are stages of denial here. We knew we're going to face some denial as the Fed shifts from quantitative easing to quantitative tightening. And the first stage of denial was last year. You got to stay long stocks, don't panic, don't be concerned that the Fed will shift the policy and move to quantitative tightening because inflation is transitory. We've heard that argument from everybody, from the administration, from the Fed, from the Treasury Secretary, from everybody else, Wall Streeters alike. We now know that this argument is kaputs. Poof, gone. Didn't make sense then, and it certainly doesn't make sense right now. So the second stage of denial is, well, it's okay. It's okay if the Fed raises rates, no problem here, because the economy is strong, because the market can handle higher interest rates by the Fed. The market is so strong and resilient, it should actually welcome the normalization of interest rates by the Fed.
Well, I just think it's just the beginning, right? And the fact that all of a sudden they're coming to this understanding that, oh my gosh, we really are behind the curve. We have to do stuff and we have to do a lot more of it. And it's not just 50 in May. Now it's like, are they going to go 75 in June? I think the economy can handle it because
75? If they go 75, you think the economy can handle it?
50 plus 75 in total is not that much in terms of where rates are going. So to me, the economy can handle it because, what did I just say, right? Services.
Once they realize that this stock market and this economy is a fugazi, both the economy and the stock market have been drug addicts, feeding off the Fed's quantitative easing, kicking the can down the road, stealing from the future generation of Americans to create gains and rescue Wall Street's ass in the present. And all of these gains that we've seen throughout the years, at least in the last 10 years or so in the economy and the stock market, were phony. They were fluffed up because of the drugs by the Fed. Well, now the drug dealer says, I can no longer supply. I can't because we have inflation. If I continue to supply the economy and the stock market with quantitative easing, this will push inflation higher. We talked about the analogy that when inflation rises higher and the Fed continues to ease, we see tumors developing in the body of the economy in the form of risk, and that risk will implode on its own either way, creating a financial crisis. Therefore, it is imperative for the Fed to tackle inflation down. And the third stage of denial, once they realize, well, the economy and the stock market are not really that strong and resilient and yada, yada, yada. Well, they go, okay, relax. Don't need to panic here. Keep buying the dip because the Fed is going to pivot. You know why? Because we have peak inflation.
So I don't think the Fed has to do anything. And the inflation rate's going to continue to moderate probably back to its range by next March. So I'm not sure the Fed is going to be nearly as aggressive as they're talking about in terms of raising rates. whether inflation's hot or cold, whether the Fed's hawkish or dovish. I think it's saying that we're into a new easing cycle, and as an investor, do you want to miss that?
I know they had a jubilee back in August, jerking off all over the place as we got the CPI reading and it came out down a little bit, at least month over month. We said back then you cannot take that as a sign for security that inflation is gone or peaking, because we have no indicator whatsoever that the Fed is in the driver's seat, and the Fed is not going to succeed in fighting inflation and beating it until it grabs the steering wheel and says, I'm in charge, not you, inflation. And they can only do that by raising interest rates above the rate of inflation, at least the core inflation reading. And the moment we got the September CPI reading, which was a reading for the month of August, and it came out higher than expectations, meaning a rebound in inflation, well, argument number 3 went out of the window. So we moved to the 4th stage of denial, which is we'll continue to buy the dip because the Fed will pivot because the economy is in a recession and it can no longer handle this pressure by the Fed. Well, wait a minute here. 5 minutes ago, you were saying that the economy is resilient and strong and it can handle Fed rate hikes. Now you're saying, oh, the economy and the stock market cannot handle these higher interest rates by the Fed because we have a recession risk, and this will push the Fed to pivot.
Our next guest suggests the market is underestimating odds of a Fed pivot. Nancy Davis is the Chief Investment Officer at Quadratic Capital Management. She runs the firm's interest rate volatility and inflation hedge ETF. Nancy, welcome to the show. Welcome back to the studio. First time since 2019. We had a chance to chat in the green room. So it's not necessarily a Fed pivot, but sort of the notion that maybe the Fed could ease off of full hawk a little earlier than what we think.
But you're forgetting about the inflation part. Inflation did not go down. And once the Fed came out and said, you know what, we don't give a shit. If the economy is going to go and dip into a recession, so be it. We're 100% laser focused in beating inflation. Of course, it's saying this right now. Who knows what's going to happen later on? But this was good enough to make argument number 4 be laid to rest. And now here's the new one. This is the bottom. You gotta buy stocks right now because the Fed is gonna pivot. But wait for it this time around because the Fed has no other choice but to pivot in order to avoid a financial systemic risk.
And those calls that have grown quite loud that the Fed should maybe do nothing at their upcoming meeting, and they should just kind of take a look around and wait and see and let everything filter through the system before they cause stress that they can't reverse.
Such as a blow up in a certain financial institution, for example. And this is what the bulls are rallying the stock market based upon. Hey, bro, we're about to have Lehman 2.0. Buy stocks. And this is exactly what Mohamed El-Erian warned about when the crowd was saying the Fed is going to pivot because peak inflation or a recession risk. El-Erian said that an economic accident has to happen before the central bank pivots. So what a dumb reasoning to rally the market based upon. You're assuming that the Fed is going to pivot to avoid the financial systemic risk. But in all likelihood, they're not going to pivot until it actually happens. AKA when the shit hits the fan. Do you want to be involved in the stock market when the shit hits the fan? I don't think so. What's up with this stupid obsession of a Fed pivot anyways? Here's Mohamed El-Erian.
First, an interesting element of this is, we're looking at green on this screen. I mean, we're showing you red right now on Credit Suisse, but green in terms of the futures, in part on perhaps expectations that maybe the Fed pivots because they see, if they're data dependent, they see this news and say to themselves, maybe we got to take our foot off the neck of the economy.
Yeah, we got to work. We got to stop with this love affair with the pivot. We saw what it resulted in during the summit. If the Fed pivots, it's because we've had either an economic accident or a market accident. We should not be wishing for that because the journey to a pivot would be painful. I'm not surprised we're seeing green. Let's not forget how horrible September is. But Andrew, ask yourself the question, are you confident that the Fed can not only balance control of inflation and employment, but also financial stability?
And what he basically said is the Fed is losing control here. The Fed is losing control of the fight against inflation. The Fed is losing control in the market narrative that they are in charge. And the Fed is losing control in mitigating all of these potential disasters stemming from any financial risk. This is a really dangerous environment. We know that the Fed rate hikes are causing a lot of dysfunction in the equities market, but most importantly, in the credit market. Folks, we're talking about unwinding over a decade worth of conditioning in both equities and fixed income markets. This is not going to be easy at all. Investors fled risky assets over fears of a recession, pulling $3 billion from high-yield bonds and $1.9 billion from leveraged loans in the week ended September 28. Spreads in the high-yield market could rise around 600 to 650 basis points if the Fed continues with its pace of rate hikes. This is according to Bank of America. The average high-yield spread stands at 561 basis points, and that was on Friday. And as you can see, junk yields are rising significantly higher, almost getting really close to the peak in 2020 in the aftermath of the crash of the thing phenomenon. Why is this important? What does that actually mean? You see, if you have all of these junk bonds yielding significantly higher, 9, 10, 12%, do these zombie companies who issued these junk bonds have the financial means to deliver on these high rates of yields? And if these rates continue to explode higher, we're going to see a lot of collateral damage in these zombie companies, in financial institutions, in all of these funds that are issuing ETFs and levered ETFs. And this is exactly the core of the argument that the Fed has to pivot or pause to give these zombie companies and these institutions a break, to at least figure out what they're going to do. What plan do they have? And now you might say, hey, Maverick, but these are junk companies. They have it coming. It's not just junk companies. Even in the LQD, which is the investment-grade corporate bonds ETF, we have seen the largest inflow since March 2020. In other words, yields are surging higher. We might find some risk even in the corporate grade bonds, because you never know what's hiding under a rock until you lift it. And with these yields surging higher, impulsively so, they're lifting all of these rocks. And we've been asking in this channel, what is the hidden accelerator that will cause a financial crash just like we saw back in 2008, the great financial crisis? In that episode, it was Lehman Brothers, it was firms like Bear Stearns, it was the CDOs in the housing market, and we're about to find out what's hiding, what is the hidden accelerator this time around. It might be hidden in daylight. We might be already aware of what that hidden accelerator is. We just chose to ignore it. Some would say it is the bond market. Some would say it is the credit market. Some would say it is the crypto market. Well, no, what we know. But there are folks right now working their asses in identifying what is the hidden accelerator. Whether it is high yields or double Bs, Bs, triple Cs, they're all collapsing, and they're yielding higher yields in a rapid pace, which is really hard for anything, be it the corporations, be it the Fed, be it financial institutions, to cope with this rapid rise in interest rates across everything. And this is all being done because the Fed is tightening the monetary policy and they're increasing their own Fed interest rate. The headline read, credit markets moves toward breaking point as investors flee, sales flop. What are they talking about? Here it is. And this is from last week. It reads, banks this week had to pull a $4 billion leveraged buyout financing, while investors pushed back on a risky bankruptcy exit deal, and buyers of repacked loans went on a strike. But the pain was not confined to junk. Investment-grade debt funds saw one of the biggest cash withdrawals ever, and spreads flared to the widest since 2020, following the worst third quarter returns since 2008. I wonder what happened back then. The market is dislocated and financial stability is at risk, said Tracy Chen, portfolio manager at whatever, who cares. But this is the most important part, adding investors are going to test central bank resolve. They're going to create these rallies and hope that the Fed is going to listen. What they're forgetting about is, if you want the Fed to listen, you got to let the market crash. You got to let that systemic risk appear, at least within the realm of immediate possibility. And then the Fed is going to pivot. But buying beforehand, saying that the Fed is going to pivot, assuming that they will pivot, and then what happens when the Fed doesn't, and it does only after the financial accident happens. Again, this is the stupidity going on in the stock market right now. We talked about the risk in junk bonds, we talked about the risk in corporate grade bonds, but even in the blue chips, when we look at the bond index, for example, this has been the worst year in history, the worst year ever. But hey, rest assured, with all of this going on right now, all what it takes is the Fed to pivot. Okay, so we avoid the immediate risk of a financial accident, but at what cost? At inflation rising higher again? These are the choices that the Fed has right now. Letting inflation go and rebound higher, which is a more permanent risk to the economy, or continue to tighten, cross their fingers, and hope that this will be a mild recession with no financial accident. And in either scenario, we're all screwed. Thank you to the Fed's incompetence, shall we say, because financial risk is now becoming contagious. When we talk about volatility and risk, the volatility indices for both the bond and currency markets have already reached the same peak, the same high from 2020 during the crash of the thing. So some would argue that the VIX for the stock market, the volatility index for stocks, is lagging, and it's just a matter of time before it reaches the same reading from the peak of 2020, if not even more. But hey, this is a good buying opportunity, right? And a lot of folks have been warning about financial systemic risk. Larry Summers warns that the risk building in the stock market looks similar to the onset of the great financial crisis, as volatility in the UK threatens to spread globally. And I even tweeted and said that I have these Lehman vibes. It feels eerily similar. But again, do we have another choice besides letting inflation go and face hyperinflation, maybe prolonged stagflation in the economy? We have things break either way. The Big Short, Michael Burry, who called the last crash accurately, also warned from this exact scenario. The Big Short, Michael Burry, sounds the alarm on shaky markets and fears a worse disaster than the financial crisis. Now, this guy knows what he's talking about, even though the geniuses in the retail investors community say, oh, Michael Burry, what does he know? He's a broken clock, bruh. Yeah, right. Today, I wondered aloud if this could be worse than 2008. Burry said in a now-deleted tweet on Thursday. What interest rates are doing exchange rates globally, central banks seems reactionary and in CYA mode, he added, using the acronym for Cover Your Ass. Burry was likely referring to the Federal Reserve and other central banks frantically raising rates to curb stubborn inflation. The Fed's aggressive hikes, combined with overseas headwinds, such as the Russia-Ukraine war and continued lockdowns in China, have driven the US dollar to record highs against other world's currencies such as the British pound. And just a few days ago, market bulls, the optimists, the pumpers, and the likes were saying, hey, the Fed has to intervene to prevent financial risk by devaluing the US dollar, which is absolutely absurd. And it's not going to happen, at least not right now. So the market took it upon itself to say, you know what, we're not going to wait for the Fed or the Treasury to devalue the dollar. We already have a pivot in England. We have the BOE buying bonds now and fluffing up the British pound. At least they're trying right now, and this effectively pushed the dollar down, and as a result the risk of financial accident went down slightly. But who's to say that the dollar is going to stay down? So the bulls needed another piece of evidence here, and that piece came from the ISM manufacturing index. But folks, in reality, let's talk about the elephant in the room. What really encouraged the bulls today to take the risk, to buy the dip and initiate a market rally. And this piece of evidence came from overseas overnight from Credit Suisse. You see, the market initially did not like the news that we got overnight, which is basically through the weekend we got, let's say, social media posts basically saying, hey, watch out, Credit Suisse is the new Lehman. Just look at the CDCs, the credit default swaps. They're reaching the same levels from back in the great financial crisis, indicating systemic risk in Credit Suisse. And again, the market did not like it, and the stock was down at least 8%. But then the market started to digest and said, you know what? Isn't this the greatest piece of evidence that we have for the Fed to argue for a pivot? Hey, Mr. Jerome Powell from the Fed, what do you say about one of the largest financial institutions in the world collapsing because rates continue to move higher, yields continue to move higher, and the risk of defaults and institutions blowing up is increasing? The risk of defaults is increasing, and Credit Suisse cannot take it. And if Credit Suisse goes down, it's going to be contagious. Deutsche Bank will go down, Barclays, UBS, Wells Fargo, all of these trash banks, they might not hold along with Credit Suisse. And the market had an aha moment. We saw shares of Credit Suisse recovering, and the futures here in the stock market in the United States surging higher. Now think about Credit Suisse as, you know, back in college, spring break. It is a time of letting go for all of these responsibilities and testing boundaries, taking a little bit of risk here and there. Credit Suisse is basically the guy who says, yeah, I don't need a condom this spring break, I'm good. And then fast forward 2 weeks later, goes back home and Anyways, this is Credit Suisse for you. It is the worst among banks, even worse than Douche Bank. The performance of Credit Suisse stock is absolutely abysmal, down almost 60% year to date. Now, equities go down 60-70% when you have speculative stocks, IPO kind of stocks. But when the stock of a large type financial institution such as Credit Suisse goes down by 60%, and we're not even done with the year, that should send some alarm bells that something is going on wrong here with this company, with this bank. Matter of fact, the stock price of Credit Suisse is about to go below book value. So either this is the greatest buying opportunity in history, or this is spelling doom and saying, watch out, this might not hold if rates continue to rise higher. Among the riskiest banks, the cost of insuring loss-absorbing senior bank bonds against default is the highest in Credit Suisse, and it has recently surged significantly higher. This is really alarming. On top of that, the cost of hedging counterparty risk for Credit Suisse also exceeds that of Deutsche Bank and Barclays. So we know that Credit Suisse is the weakest. And now they say that if you want to buy the dip in Credit Suisse, this is a buy for the brave. You mean the same braves who lost their diapers in the crypto massacre? But you want to know who the braves are? How about the largest holders of Credit Suisse? If it collapses, number one is BlackRock. So you want to talk about contagion here. You want to talk about systemic risk. This is exactly what's going to happen if Credit Suisse indeed collapses. And why would it collapse? What is the reason behind the weakness and the underperformance by Credit Suisse? Well, here's a background for you. You might remember last year, we had the whole Archegos debacle, and this cost Credit Suisse at least $5.5 billion. Poof, gone from one client alone. And the bank knew that Bill Wong of Archegos was a persona non grata in the banking community. Nobody would give him a loan. Archegos' collapse came as a shock to outsiders, but the risk of doing business with the fund had been apparent for years. In 2012, Mr. Huang, this is the founder of Archegos, well, he pleaded guilty of U.S. charge of wire fraud while running another fund. Not only that, the man settled insider trading allegations with the Securities and Exchange Commission, the SEC. He had also been barred in 2014 from trading in Hong Kong. But in 2015, Credit Suisse employees shrugged off, quote-unquote, Mr. Wong's history after reviewing the risk of doing business with him. Nice shrug, isn't it? It's worth about $5.5 billion. And of course, the report says that this was due to incompetence. It wasn't due to a conspiracy theory or doing favors to Bill Wong or any connections of that sort. And I say bullshit. This is corruption 101. Bill Wong knew insiders in Credit Suisse who can expedite and turn a blind eye to his applications. And this has been going on for years until they got caught when Archegos collapsed. But before that, in their reviews of Archegos, Credit Suisse characterized Archegos as having a solid capital base, quote-unquote, along with an experienced management team, strong performance, and appropriate use of leverage. However, they also identified such crucial weaknesses such as key man reliance, volatile performance, poor risk management practices and procedures, and mediocre operational management practices / fraud risk. Wait a minute, you said they have an experienced management team, but they also have a mediocre operational management? What's going on here? This is how you know this was a corrupt deal. He knew somebody in the inside, and he got all of these loans, billions of dollars worth of loans. And he gambled in the stock market by using derivatives and risky strategies, and the rest is history. And after that, the veil has been lifted off Credit Suisse. The rating agencies started downgrading the bank. Hedge funds, research firms, the media started scrutinizing Credit Suisse operations. And we got the downgrade from Fitch. And after that, Credit Suisse started losing its top employees to other competitors. And the bank had to come up with a rescue strategy, not only to mitigate the risk, but to reassure the market, to restore confidence in Credit Suisse. And they thought about selling certain assets. They're down in the hole about $5.5 billion. They got to make up for that by building more financial cushion. And they even touted Warren Buffett ideas. There are two ways to fix Credit Suisse Group: quickly and expensively, or slowly and expensively. Which one do you want? Its leaders know the Swiss bank's problems, and they have a good idea what they want the bank to become. The puzzle chat that Chairman Axel Lehman, wait a minute, they have a chairman with the last name Lehman, and the rest of the board are struggling to solve is how to get from here to there and how to pay for the journey. How about bankruptcy? Rumors are flying. It could quit the U.S. entirely. It could split into 2, maybe 3 pieces. Outside investors, you get the deal. The bank is in trouble. No doubt about it. With higher rates, they're gonna break. And of course, it wasn't long ago when we got the news from the SMB that they are raising rates by 75 basis points. Now, a lot of folks have the misunderstanding that when central banks raise rates, this is good for financial institutions. But is it really? Theoretically, they can charge more by writing new loans, but what happens to their existing loans when the interest rate on those start to rise higher? What if their clients start to pop and they bust on their loans because interest rates are moving higher? What is the risk that the bank has to assume? And does the bank have enough cushion to absorb the shock? You see, a lot of folks say that this is not a Lehman moment, including renowned economist Mohamed El-Arian, but what they're looking at is the leverage ratios, and when we look at those, yes, they are improving, even for Credit Suisse. But here's the problem. If we take one of them, for example, the Tier 1 capital ratio, we know what Tier 1 is for Credit Suisse. What we don't know for sure is the denominator. What is the total risk-weighted asset when interest rates move higher? Can you even quantify that? And the leverage ratios aside, this is a bank that is not doing so good. The revenues in the latest report were down 17% quarter over quarter, and the revenues were down 29% year over year. The net income was abysmal. It was a loss of almost $1.6 billion, and the cost-to-income ratio is increasing dramatically. It is now standing at 130%. In other words, the company spends more than it makes. Hence, where is the cushion? And is it enough if more of their clients start to explode as interest rates continue to move higher? For now, they say, yeah, Credit Suisse can handle it. But we know that the bank has major exposure to Europe, and this economy is collapsing, be it Germany, be it Britain, be it the Netherlands. And as a result, when we look at the second quarter of 22 versus the second quarter of 21, and look at the change in the sources of revenue in a matter of year. The share of Switzerland was at 30% in 21. Now it stands at 39%. The EMEA, Europe, Middle East, and Africa, last year, about 28% of Credit Suisse revenue came from that region. Fast forward a year later, and that share went down to only 16%. Is it because Credit Suisse expanded their local operations on the expense of EMEA, but specifically Europe? The answer is no. And the real answer is Credit Suisse European revenue is collapsing. Look at the latest report for the company. Credit Suisse income from wealth management is dropping down dramatically. Matter of fact, here it is. WM had reported net revenues of 2.4 billion francs, down 39% year on year. This is a problem, but it gets even worse. Look at the investment bank income, collapsing. The division's reported net revenues were $3.2 billion, down 48% year on year, largely driven by significantly lower capital markets revenue and lower fixed income and equity sales and trading revenues. What about asset management? The trend is down, no surprise here. AM had adjusted pre-tax income of 82 million francs for the first half of 22. And listen to this, down 68% year on year due to adjusted lower net revenues, down 18%, coupled with higher adjusted operating expenses up 4%. Okay, this is a mess. Their asset management revenues down 2% year over year. Can't you see the problem here? And folks, lastly, if you're looking for a job, well, Credit Suisse is hiring, and they're looking for a business risk analyst. And it says the job is no longer available. We don't need risk analysts. We know what's going on here. We're going bust, baby. But here it is. It says you have some responsibilities if you want to do this job. You can play an integral role and be responsible for frameworks and strategies of FLDS control assurance, blah, 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 blah. You play an integral role, not an integrity role. You're also going to directly support CA management on any matters related to CA and or assurance requiring managerial support. In other words, the manager is not here. You got to do the job alone. So be the go-to person for advice and or solutions to problems and hone your problem-solving skills because you're going to need them. Be challenged to be at the top of your game and one step ahead of the constantly evolving environment by preempting issues and preventing problems before they happen. You mean like Archegos? Collaborate with many different collaborators, including front office, competency centers, wider FLDS teams, business management teams, and other LODs. Just make sure you don't get any STDs. I'm being trusted to handle any ad hoc projects and initiatives and deliver either individually or as a team with minimal mentorship because we have no money to pay mentors. And there are no teams either. So good luck. And the job listing says your future colleagues, the controls assurance CA teams focuses on who cares? How about your future colleagues, very sad people, just like you're about to be. And you offer, what do you offer? Yes, just say yes. Whatever we tell you, you say yes. And Credit Suisse is an equal opportunity offender. We're going to overwork and blame you, doesn't matter what color you are, for our missteps. You're going to take the blame. You're going to lose your job. You're going to lose your income. And we're going to look for a bailout from the government. Good night. And with that, folks, this lovely story of financial collapse, let's move on and cover the stock market information for you. We start with the closing of the indices today. And here we go. The Dow Industrial Average pretty much on the flat line, be it with a negative closing, down 42.45 points or a decline of 0.14%. The Nasdaq down by 27.77 points or a decline of 0.25%. The S&P 500 down by 7.65 points or a decline of 0.20%. The sector's performances today, different than yesterday. We're back at the commodities trade. Energy came up number one, and I would say capturing the gold, the silver, and the bronze metals. Because yes, we have a positive closing for technology and healthcare, but energy managed to outperform by a lot. Meanwhile, the laggards of the day led by REITs, utilities, and materials. The dollar was down, materials were down, yields were up, utilities and REITs were down. Why was energy up? The answer is OPEC+. What about the advance to decline ratios? NYSE 31% advancing versus 68% declining. The Nasdaq 36% advancing versus 61% declining. What about commodities? All eyes were on crude oil. We got OPEC+ out of the way, and the supply cut was of 2 million barrels per day. A big one. Yet the reaction was modest today in crude oil futures because they've been rallying ahead of the meeting. The WTI closed the day with gains of almost 1.5%. On the other hand, Brent closed the day with gains of almost 2%. We'll talk about OPEC+ in tomorrow's video because something really important happened today. We'll talk about it tomorrow. In the meantime, natural gas was up by almost 1.5% and heating oil up by almost 5% for the day. What about softs and grains? We have massive moves here by cheese and milk futures, double-digit gains in a single day. And then we have a notable mover to the downside, that is OJ futures. Massive gains on the heels of the Florida hurricane, but now we're seeing profit taking across the board. And OJ futures were down by about 4% for the day. Likewise, when it comes to softs, coffee futures were up by almost 2.5%. On the other hand, cotton down big by a little over 5.5%. When it comes to grains, soybeans were down by almost 1%. Metals, gold muted for the day, losing a little ground here. Yet silver futures were down by almost 3%. Silver scored massive gains on the heels of the dollar pulling back. Now that the dollar is stabilizing, we're seeing some profit taking from silver. Likewise, platinum was down by a little over 1.5%. When it comes to meats, the notable mover is lean hogs, the new big tech. It might go down once in a while, but it always rebounds. And today it scored gains of 4.5%. On to the options market, the big casino. What's going on here? The volume once again moving higher, but folks are buying more puts now. This is not a good sign for the sustainability of the relief rally, despite the fact that we have a large whale type of trade that took place today. Regardless, the hottest table today was Tesla, the souffle, at around 2.5 million contracts traded today. About 53% of those were calls. Tesla down big for yet another day. Who saw that coming? Oh yeah, the guy you're listening to right now. And then we have Apple at number 2 at around 1.4 million contracts traded today. About 58% of those were puts. So they're betting for more downside for both Tesla and Apple. And at number 3, Twitter. The deal is done. 54.20, right? 420. That's what Elon wants. He thought it was a joke. Now he has to pay for it. And Twitter came at number 3 in the casino with about 1 million contracts traded today. Look at this. 51% of those were puts, not calls. Now you would say, what about the arbitrage? Shouldn't Twitter close the gap and rally all the way to 54.20? Well, somebody sees the deal falling apart or maybe not closing at the same price, and they're betting against Twitter for some reason. Now let's talk about the trade that moved the market today, the rescue trade done by the PPT or whoever, who cares? The result is the same. The market rallied all the way back to the highs of the day. And here it is. Somebody bought the 4,500 calls for the SPX with the expiration date of January 20, 2023. They paid around $11 a piece to enter this trade, all in all spending around $50 million. So this was the reason behind the rebound today, the reversal. But is it sustainable or not? That depends on an important fundamental mover that is coming up on Friday, which is the employment report. Of course, it all depends on what the dollar and the 10-year will do. In the meantime, let's move on to the unusual activities that took place in the options market today. And we start with the ticker COF. This is for Capital One. Somebody's making a large bet here that Capital One will go down. I mean, so far this year, the name has been an ugly underperformer, and somebody's betting for more pain to come. Now, if I'm connecting the dots here, today you might have heard the reports all over the place that car loans are now reaching $1,000 a month, and this is becoming quite average. A lot of folks are paying over $1,000 a month in car loans, and they have extended terms, by the way, sometimes to 9-10 years. What is the risk here? With interest rates moving higher, with an upcoming recession coming, and perhaps accompanied by a surge in unemployment, a lot of folks are going to lose their jobs. When they lose their jobs, they lose their incomes. When they lose their incomes, the easiest way to get rid of any financial obligations that you cannot really afford is getting rid of your car, meaning a lot of repos will happen. And if they do, what is the impact on the economy? Number one, is this the subprime car loans or what? Number two, one of the major lenders in the car loan market is Capital One. And if a lot of their customers, a lot of their loans go default and the cars get repoed, well, they're set to lose a lot of money. And perhaps this is what the trader sees because they bought the $90 puts for the expiration date, October 28th, with expectations that Capital One will go down and lose more than 9% of its value by then. They paid around $1.85 a piece to enter this trade, all in all spending around $4 million. And then what about the ticker LAD for Lithia Motors? Somebody sees more downside coming for this name. It is an underperformer for the year, and somebody sees more pain to come. They bought the $200 puts for the expiration date, November 18th, with expectations that the name could go down and lose more than 8% of its value by then. They paid around $9 a piece to enter this trade, all in all spending around $9 million. What about the ticker TDOC, Teladoc? Oh, what a disaster this name is. And somebody sees more pain to come. And by more pain, we mean more pain for Mama Kathy, who happens to be one of the largest shareholders of TDOC. Anyhow, somebody bought the 25 puts for the expiration date, November 18th, with expectations that the name could move down and lose more than 7.5% of its value by then. They paid around $2.55 a piece to enter this trade, all in all, spending around $2.5 million. And then what about the ticker EVBJ for Everbridge? The name got absolutely nuked since the highs. The stock is now trading below its 2020 lows. This is a disaster in the making, but somebody sees enough pain already. Somebody sees the light at the end of the tunnel and a rebound coming. And they bought the 35 calls for the expiration date, December 16th, with expectations that the name could move higher and gain more than 7% by then. They paid around $3.65 a piece to enter this trade, all in all spending around $2.5 million. On to the heat map. What's going on here? The majority of the pain happened in financials. It happened in utilities, in REITs. Now, REITs and utilities, we know why. Yields are surging higher again, and utilities and REITs, the ultra-defensive names, there is a point, there is a threshold when yields come too high where utilities and REITs lose their allure. The main reason to invest in REITs and utilities is to capture dividends. But when you have the 1 year, the 2 year paying 4% plus, risk-free, that is a better deal than utilities and REITs, and therefore money comes out of these and it goes back into the fixed income market. Financials are down, lots of problems here, lots of systemic risk. We have an indebted, over-leveraged economy, and interest rates continue to move higher. Something is going to blow up here. We also have weakness in the auto manufacturers, led by Tesla. We know this name is going to face a lot of challenges from this point on. Likewise, the rebound in the dollar today allowed materials to go down. Gold was down, but what's really troubling for me is defensives continue to go down. This tells me that the market is losing faith here, number one, or it's taking money away from these defensives and it is moving back to the offensives. If you want to read it that way, you got a lot of supportive evidence here from the outperformance of technology, specifically chips, but even the big caps, Apple, Microsoft, were in the flat line for the day. So you could say that money's coming out of defensives, moving into offensives. I don't see that. I don't see a lot of that at least, but perhaps soothing a lot of fears from the declines in REITs and utilities is the outperformance by healthcare. Be it the big pharma names, the insurance names, these are dividend-paying names. When they're holding pretty good and they're catching a bid, you still have support here. You still have an argument where you say, okay, maybe the name is not paying as much as the 1 year or the 2 year, but the fundamentals are intact because there is no recession in big pharma. Medicare is going to pay, and if anything, it's going to pay more and more and more. But the outperformer all in all was clearly energy. Number one, we have OPEC Plus, which we're going to talk about in details in tomorrow's video. Number two, the dollar kind of paused midday and started to move down. And that came hand in hand with a rally in equities, but most importantly in commodities-related stocks, in this case, energy. I've been talking about names such as Oxy and Devon specifically. Massive gains for Devon so far this week. And I've also been talking about a name, SLB, which I covered not a long time ago. I covered the chart and I said that I'm buying the dip. And today we see the name leading the gains in the stock market. We'll cover the chart if we have time, but in the meantime, let's move on to the heat map for the ETFs. Anything to see here? Obviously, we have weakness in international. The European ETFs were down big. Developed markets were down big. These happen to be really sensitive to the rise in the dollar. And every time we have a rebound in the US dollar, we see an underperformance by developed market and European equities. On the other hand, EWZ still holding for Brazil, and Chinese equities performed a lot better. When it comes to stock market ETFs, once again, the outperformance came from energy energy ETFs, such as the XOP, XLE, OIH was up big, over 4% for the day. Natural gas ETFs, be it the UNG, the ticker BOIL, BOIL, all in the green big time. But again, we have OPEC Plus as a supporting factor here. Other dollar-sensitive commodities-related ETFs did not outperform today. We're talking about the SLV for silver, down almost 2%. We're talking about the GDX for gold miners, down almost 1.5%. So we have a little bit of a mystery here where the US dollar was initially higher for the day, and this impacted commodities-related ETFs negatively, specifically metals. But somehow energy ETFs managed to hold the gains, and they added to these gains once the dollar started to move down. And hence, we talk about the supporting element here, the OPEC Plus production cut. Moving on to the SPY 30 minutes chart, what do we see here? Yesterday, we talked about the bull flag formation and the likelihood that it's not going to play out. The pattern says one thing, but the psychology says another, and the overextension in the RSI made the risk versus reward says a pullback is coming. We got a pullback right away. The chart lost 373.5 as support, but then came the rescue trade midday, and the SPY managed to close at the highs of the day. It closed the gap, and it closed pretty much right at the gap. Is this a positive closing or a negative closing? Let's talk about the behavior of the chart. It gaps down and then it closes at the highs of the day. Maybe you have a bias. Maybe you happen to be a bear, like I am. So let me put it this way. What happens when we see a gap and crap? The chart gaps higher and it closes at the lows of the day. Is this a positive or negative chart behavior? The answer is it is negative. It is a bearish chart behavior. So what happens when we have a crap in the morning and the chart ends up closing at the highs of the day? The answer is we have bullish behavior. We have positive charting behavior. This is at least the bull's argument looking at the 30 minutes chart. Do the bears have a counter? The answer is yes. The bears would say the reversal and closing at the highs of the day happened because a mechanical reason. Tomorrow, the mechanical reason goes away. This was a hedge right away and it happened, it took place, and that's that. Number two, look at the RSI indicator. It has a negative divergence, telling us that the move that we got today lacks the strength, and therefore the risk is to the downside, that the chart could break below 373.5 once again. Why do the bears say that? Why do they say that this move, this rebound, this reversal is weak? Well, the RSI says that by the negative divergence, but what does that really mean? It means when we take a look at the daily chart for the continuous contract for the S&P 500, we see the volume moving down. We see the move happening on an anemic volume. That lacks the strength. It lacks the conviction. You want to see moves and reversals by a spike in the volume, and this is not what we saw today. However, the volume being down, it makes it a one-way street for the bulls to continue to move the chart higher, at least for now, until a fundamental catalyst comes in the picture and it pushes that volume higher again. Another good sign for the bulls is, number one, the RSI is improving. It is firming up once again. We have a crossing in the MACD indicator saying that at least on the daily chart, the momentum has reversed. The momentum is now positive, not negative. And what is the bear's argument at this point? Well, it says this is a rally based on nothing, false hopes and dreams, yet another bear market rally. The pivot is not going to happen, and the data will support that. What data are we talking about? Number one, the employment report coming out this Friday, and next week the CPI, and right after that, earnings, which will come out disappointing. So the bears have the fundamentals on their side. The bulls, at least for now, have the advantage in the technicals and the mechanics. What about the Qs? 30 minutes chart. What's going on here? We talked about the false bull flag, that it might not come in play because we have overextended RSI, overbought, quote unquote, which makes the risk to the downside. And indeed, we got the gap down in the morning and the chart lost 280 as support, but by midday we got the pump, the rescue operation, and the Qs managed to close at the highs of the day, closing the gap and closing the day above the gap and above 280. Is this bullish behavior or bearish? The answer is easy. This is bullish behavior. It's not bearish at all. But do the bears have an argument here? Do they have a counter? The answer is yes. Once again, looking at the RSI and saying, hey, this is negative divergence, indicating that unlike the last leg, this leg lacks momentum. But most importantly, it lacks conviction because you need to see the volume higher, not lower. Here's the daily chart for the continuous contract for the NASDAQ. Again, the volume is below average. You could see this as a short-time good sign for the bulls because it makes it once again a one-way street to move the chart higher. But this will be a difficult endeavor right now because we have stiff resistance at around 11,689. It's going to take a lot for the chart to break above this number. The RSI, it is improving, but it is within the territory of negative divergence. The MACD did not give us any solid confirmation for now. The week is still young, but it is in positive momentum now. If the chart closes the week in positive momentum and we see the weekly MACD also improving, then the bulls gain a lot more ground and they become more convincing. But for now, a lot of doubt is still here. This is yet another fake bear market rally, and then down we go once the data comes out. The IWM, the Russell 2000, 30 minutes chart, what's going on here? A gap down all the way to the support of 171.40 and rebounding from that number and closing the day above the most important support at around 174.75. Now the IWM closed the gap, but it closed the day below the gap, yet above the support. So we have mixed messages here. The bulls would say, hey, look where the chart closed. Regardless of the gaps, it closed at the highs of the day, reversing the majority of their early losses. This is bullish behavior, not bearish. But the bears would counter and say, you did not close above the gap. You could have done that easily. And the chart chose not to do that. And again, the 30 minutes RSI suggests that we have weakness in the move by the negative divergence, and that says we're going to lose the support of 174.22, and maybe we're also going to lose the support of 171.40 and end up closing the gap downstairs. This is what the bears are saying. The bulls say no, this was yet another confirmation that the bears are losing and the bulls are gaining momentum. Another dip buying. Another close at the highs of the day, which means 183.25 is in the bull's eyes. Who has the better argument here? From a technical perspective, slightly the bulls, because the bears' argument is also persuasive. And it could get even more persuasive if we see this chart, the dollar index, the Dixie, moving higher again. Today it did rebound, but it did not manage to close above 111.2. If it does tomorrow, this will be a bad sign for the bulls, good sign for the bears. The dollar is going to pop higher again, and equities will go down and form a lower low. Absent of that, if the dollar continues to go down and it fails at recapturing 111.2 as support, the likelihood is the dollar will continue to go down, equities will like it, but specifically commodities-related stocks. We're talking about, let's say, gold, for example. Gold was down today by a little bit in reaction to the move in the dollar, but it is above 1,685. If it closes the week above this number, then we got a case to make that gold should be moving higher, above 1,800. Yet we have to wait for the weekly closing to confirm any of that. And if gold indeed closes the week above 1,685, it means that the dollar did not make it above 111.2, and it is moving down, which will also be good for this one. How about the daily chart of Brent oil? It is now above the sloping line of resistance. It has been broken. The next resistance is 98. Soon enough, we could be at 100, 110, 120, and then what? Can the market really say the Fed is going to pivot when we have oil back at above 100 once again? Not so fast. And here's the 10-year yield. We have a rebound today. We're not going to say that this is a legitimate reversal until we see a closing, preferably a weekly closing below 3.5%. Until then, all what this is a pullback. We could see a rebound and another leg higher. For now, the The RSI remains in negative divergence. The MACD remains in bearish momentum. Not by a lot, but it is here. It is showing up. And until we see the negative divergence in the RSI improving, along with a tick higher in the MACD, and most importantly, trading above the breakdown candle, the top of that candle, once we have all three, 10-year goes higher, equities go down along with the TLT. Here's a weekly chart for the TLT. RSI oversold, but who cares? We could see more downside. The MACD suggests that. And if that is the case, yields go higher and equities are not going to like it. The VIX 4 hours chart. What's going on here? The VIX is having a hard time moving all the way back to 33. Is it a done deal that we have the bulls in charge now and nobody wants to hedge? The VIX goes back to 20. SPY blasts higher. All of these are hopes and dreams right now. What I'm seeing is resiliency and relative strength in the VIX. So far, we got 2 massive rallies in a row in the equities market, in the SPY. And today we got a reversal. We got a massive call options trade. The VIX should have collapsed, but it's not. It's still holding. To me, this is a positive sign for the bears and a worrying sign for the bulls. Apple, a daily chart, what's going on here? It gapped down, it lost 145 as support, and then came the rescue operation and Apple closed above 145. And the psychology says they want to go back at 150. They want to go round number 2 at 150. And the likelihood is they could make it. But here's the important take. If they lose again, if they get defeated in the battle once again, this would seal the deal for me that Apple will go down. It topped out. It's not going to move any higher. And along with it, we're going to see a massive leg down in the SPY and the Qs. And this was just a bear market rally. Here's Apple, 30 minutes chart. The bulls are saying, hey, we have what it appears to be a reverse head and shoulder formation. It means 150 is coming. Apple 150 round number 2. Bulls versus bears. You want to play the game? Let's play the game. But watch out. You could get your ass kicked again. Tesla. An hourly chart, what's going on here? The double bear flag is playing out. The name went down all the way to 233.33. This is solid support for now, which means we could see a rebound, but watch out, once it gets broken again, that would be another signal that Tesla has another leg to the downside. What is the importance of 233.33? Let's zoom out and look at this. This is a daily chart. As you can see, 233.33 acted as support not once, but twice. I forgot to point it out here, but it was back in September 2021. So we know that this is solid support, which means if you've been short and you scored massive gains, maybe it is time to take some profits off the table. Wait for the next round. And maybe if you're going to play a rebound, maybe you can take a shot, buy some call options out of the money with a short-term expiration. And if we see Tesla popping higher as a rebound from the support, you're going to score big in these calls. Yet the overall trajectory remains to the downside. The bears are in charge. And lastly, Bitcoin, tulips. What's going on here? This is a 4 hours chart. We got a retest once again at 20,000. The chart is now battling 20,000 back and forth, back and forth. You can't really make anything here. I said yesterday if I had to lay a bet, I would say third time is not a charm. Third time is a confirmation that Bitcoin doesn't have what it takes to pass 20,000. But the bulls for now say, no, third time is a charm, and you will see all of that energy from the consolidation in Bitcoin being released, and we will see an impulsive rally higher, and 20,000 will be support once and for all. Both sides have good arguments. For example, the bulls would say, hey, if the chart wanted to go down to 15,000, it had a lot of time to do that. Instead, it chose to consolidate just under 20,000. In other words, this means this is a process of gathering energy. Once the energy is found, the chart's going to crack above 20,000. The bears would say, not really. All what it says is the chart has been waiting and waiting and waiting for buyers. The buyers are not showing up. Soon enough, the sellers are going to show up and they will push the chart down. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Most importantly, we have a teaser for Friday's payroll report in the initial jobless claims, but we also have a bunch of Fed zombies speaking tomorrow. We heard from Boystick today who said, hey, pivot not coming. Instead, we're going to raise all the way to December at around 4.5%, and then we're going to hold. What is Mr. from Cleveland and Lisa Cook, the governor, what are they going to say? We'll see what happens, but for now, this is all I got for you, folks. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow.
I was right, and everyone was wrong. And yeah, I got a bonus check for it. Sue me.